Today's video is going to be so interesting, even my cat wants to watch. Today we are covering two nearly 10% yielding, deeply discounted dividend stocks. One of them I own, one I don't, but I have been looking to buy, and these yields are phenomenal. We're going to go over a couple things with these stocks, go over their websites, the dividend history, and then we're also going to check out the drip calculator and see how much these have been returning. Now, it might be a little bit interesting with one of them. It is a higher yielding, but definitely higher risk. And the other one is the one that I own that has been so good to me so far, but recently sold off a little bit. So I hope you guys enjoy. If you like financial content, if you like stocks, dividends, investing, ETFs, all that good stuff, don't forget to like the video to let me know and to subscribe. It really helps me out, and I appreciate you guys for joining the community. So let's roll the intro. The first stock we are covering today is ticker OBDC. Blue Owl Capital Corp. It is one of my personal favorites. I do own this one because the yield is currently 11.38%, and they are down almost 10% from their peak, which was in May of this year. They're down 9.85%. Now we're going to talk about why it dropped, some things affecting the company. We're going to go over a little bit of their financial information, but I'm going to try and keep it interesting because some of that stuff can get so boring. But if you're interested in buying high-yielding dividend stocks, you need to do this research yourself. So don't forget, always do your own research. This is not financial advice. Now, I've owned OBDC for a long time. And like I said, it has been good to me. I've talked about it significantly on the channel, and I think I'm still up 20 to something percent, 25, 26% on it, which again, I'm pumped about. I have dividends reinvesting on, so I am dripping with this. And so we're going to go ahead and jump into the website and see what is going on with this really interesting BDC. Looking at their portfolio, this company, I like their website. Simplistic, but still very nice. I always say, check the websites out for companies. If you want to know if a company's a scam, you can find it pretty quickly on their website. It will be terribly done. This is professionally made, and even though I fixate on that a little bit, it is still really important. So looking at a bunch of their financial information, this is just from the portfolio page, we can see that a lot of theirs is first lien senior secured debt. Now what this means is 3/4 of their debt, if something happens with the underlying company that they've loaned the money out to, because that's how BDCs make money. They loan out money to small and mid-cap companies that need money to grow their businesses. But with this first lien, if that company goes under, they are paid first. They're paid before a significant number of other people, including those with second lien senior secured debt, which is only 6%. 6% is relatively low, so I'm okay with that. And then they have, common equity, preferred equity, and a number of other things. One interesting thing with Blue Owl is they have a high percentage of floating rate debt. And for those of you that aren't really interested in the housing market or haven't been following rates at all, floating rate is worse currently, in my opinion, because rates are coming down. And they're speculated to come down another 1.5% points, which is crazy. And so a big drop like that means that when Blue Owl loans this money out, they're making less on that money that is loaned out. And so I am speculating that has a lot to do with some of the dropping of the share value. But that being said, sometimes this still creates more money for them, because if debt is cheaper to have, more companies will take on debt. And so that is definitely something to think about. It is really good to go through and check all of this information yourself. I really recommend doing it. I always like going over the portfolio. I like it to look like this, well diversified. There is still a lot. This is just all the other industries combined, not listed here. So we have internet and software, insurance, food and beverage, manufacturing, distribution, yada, and so on and so forth. Financial services, 3%. Now, they're mostly in the U.S., Midwest, Northwest, West, and South, and a little bit international. Not terrible. I do like there to be some international, maybe 20%, just so you have some. Sometimes other international markets have a lot better growth. Maybe they're trailing behind the U.S. a little bit, and they haven't peaked with their growth like the U.S. has in some industries, but I'm not upset about it. It's okay to have most of it in the U.S., really depends on your investment style and your portfolio and how diversified you are. So what I want to do now, we're going to go over their dividend history, a really key piece of information on how this thing has been yielding plus 10% over the past however long. So let's go ahead and jump right into that. So OBDC does pay quarterly, and they are a phenomenal payer of special dividends. Now, looking at this, we can see they had a special dividend in 2022, 2023, 2023, 2023, 2023. So they paid out a special dividend for every quarter of 2023, and it looks like they're going to do the same thing for 2024, and that is part of the reason why their yield is so high. It is calculating those special dividends, factoring those in. Now, that being said, these special dividends are likely because interest rates were higher and they were making more money on their already secured debt. So it could hurt them in the future if we see fewer special dividends. Like I said, I wouldn't be surprised because the amount of money they're going to be making is going to be lower. But still, it's still just one of my favorite BDCs because of its consistent history. Now, we can actually zoom out a little bit, go back. They're not a very old company. That is something that worries me a little bit. Because they've only been trading since 2019 or consistently paying a dividend since 2019. And so we can see they have had good growth from 31 cents up to, what are we paying now? 35, 37. So some pretty decent growth. And we can also check that out in the growth tab. But first, let's check their scorecard from Seeking Alpha. Dividend yield, 11.6%. Payout ratio, this is key. So the payout ratio is 72.82%. My brain stopped working there for a second. And that means that their dividend is relatively covered. They're not struggling. They're not paying out more in their dividend than they're making. And that is a really key metric that you want to think about when you're investing in dividends, because just because something has a 20% yield, if their payout ratio is higher than the money they're bringing in, it's not going to be able to maintain that dividend. And a lot of new dividend investors overlook that. So don't forget that. 5-year growth rate is 36.33%. Can that be real? That is actually insane. The 1-year growth rate of 9.23%, dividend per share growth, really, really solid 5-year, 36.33%. So it is growing the dividend as we saw. We saw with the special dividends, it has been consistently increasing those as well. And so that's why the dividend history for this one, this is why I own this one. I think it's very solid. The growth is good. The price action is good. It's been going up. It's not losing value. You're not getting NAV erosion where you're losing money on your investment but making a lot in dividends, because I don't like that either. My cat is back. So let's go ahead and jump right into the next portion, which is our drip calculator. So using dividendchannel.com, using their drip calculator, we can see OBDC invested since 2019, because before that it was different and it messes up the calculation. We can see a total return of 70% with dividends reinvested and 46.87% with dividends not reinvested. An average total return of 10.64% annually, which I think is phenomenal. It has seen a lot of growth. There has been some tough times in the market, especially when this was kind of first created, was pre-pandemic. So I think that they have done really, really well, and I think they have a lot of potential to continue to grow. Now, I'm happy with a 10.5% return, versus the S&P 500. You'd be close to what it returns on average over the last 40 years. But still, I like having some diversity. And so I think OBDC is a phenomenal one. Plus, with the recent dip, I think that is a good opportunity to buy. I haven't purchased more yet, but I am looking to very, very soon. So let me know what you guys think about this one down below in the comments. And don't forget, we have one more. So let's jump into our next high-yielding discounted dividend stock. Rhythm Capital Corp. This is ticker RITM. I don't believe I've talked about this one on the channel so far. And looking at the 5-year chart, it is beaten up. It is beaten up 30% over the last 5 years. Most of that due to the pandemic in 2019 and 2020. So more recently, they did something that's really interesting. They created more shares, which basically dilutes the value slightly, but it raises more money for the company. So it's a negative if you are already an investor, but it also gives you an opportunity to purchase more shares at a lower price, and they will hopefully use the money wisely. If you trust the management, it's not the worst thing. It is a little bit of a bummer if you already own the stock, but if you don't, in my opinion, it's a good idea to buy it at a discount. So it is down 11.25% just since September 16. So this was very, very recent. It rebounded a little and has sold off even more. It currently has a roughly 9% yield, a little bit over 9%, but we'll check out their website and see some more details about this stock. Again, I'm a fan of websites, so I think this one does look really good. Talked about their servicing, which is important. This is a mortgage REIT, which I normally don't love. There are a few that I do like ABR and Rhythm. Those are the only two that I'm a big fan of. Most of the others I think are money traps. I think they're yield traps 100%. But we can see the asset under management, $32 billion. That is a lot of money. Dividend yield, according to quarter 2 of 2024, my stutter went crazy there, 9.2%, pretty phenomenal. Book value is 12.4 a share. Assets, $42 billion. Total equity, $7.3 billion. And we can see exactly how they're making their money. Asset management, 700 million. I believe this is newer to them. They haven't been doing it for long. And then you have origination and servicing, which is loan origination. So how they're working with the mortgage loans. You have an investment portfolio, 3.11 million, and then you have the mortgage loans receivable at 732 million. So you can actually see there is a ton of information on here. You can check out. I have one of these companies as my lender. I know of a lot of people that use most of these as their lenders, and they do have a beautiful website. You can even check out more into the details, but I'm not going to go too far into them. This is the first time I've talked about them, and I don't own them, so I want to do a deeper dive before I start spewing off too much information. But the key thing I always look at, dividend history. Let's check it out. So the first thing you'll notice is dividend cut, which is never what you want as a dividend investor. It dropped from 50 cents to 5 cents, an insane cut of what is that, 90%? So not happy about that whatsoever. Now, what is key is what they do after. So I never buy them right after the cut. I usually wait a little bit, although if you had purchased them right after the cut, you would be doing pretty well. But I usually don't buy them after the cut. I want to see if they're going to come back in a growth standpoint. And that is what Rhythm has done. We can go all the way down and check out in 2013, they were paying quite a bit. They do pay quarterly, and they did pay some special dividends as well. And then they consistently were raising the dividend. You can see 48 cents here, 50 cents, special dividends of 10 cents, of 15 cents, and then continuing that trend. And then we saw the cut, which was in 2020, I believe exactly. Yes, 2020. And so we saw that drop because it paid out a lot of really random numbers. I'm not sure why, but then the drop happened, and then it was, 20 cents, 25 cents, and continuing to climb since then. So not happy about that at all. I do wish they had been able to, keep their way through the pandemic, but it's just not plausible for a mortgage REIT at that time. I don't know of any that didn't cut their dividends besides ABR, which is Arbor Realty Trust. No, that's not the right one. Besides ABR, it was ABR. And so, I'm happy with the dividend consistency. If we jump over to the scorecard, we can see the details. 9.5% yield, a little bit higher than they put in their 2024 Q2 reviews. We can see that the payout ratio very low at 49%. Now, when I look at this, this means special dividends, especially because they have a passive special dividends. If they don't, I'm glad that they're still holding on to the capital, but I do think there is some really good potential for some dividend increases. Now, the dividend growth is going to be negative because they did have that cut. So all of this is void. But since the cut, they have been increasing it pretty significantly. So overall, our drip calculation is next. We'll see how this one has panned out. It's definitely higher risk, higher reward. But I want to know what you guys think about these higher yielding REITs and BDCs. Is it something you invest in over SPY? Let's go ahead and jump at that drip calculator. The drip calculator for this one is going to be ugly because they are down all time. But let's take a look at it. Yeah, it's pretty ugly. So average annual return of minus 0.4%, total return down $8.4%. I'm thinking in dollars. And this goes all the way back to 2001. So like I said, the pandemic crushed this one. Prior to that, it would probably have been doing pretty well, but it erased all of the gains, and we can actually see it had been crushed at the beginning and then kind of trailed back up and then was now crushed again. So again, this one is speculative. Reinvesting was better by about a 30%, which is always good to see, but it is really interesting. Let me jump back over to that chart for you guys. If we do the max chart, you can see, yeah, it is beaten down from the 1350 it started on. Since the drop, they have been growing. I believe there was something big that changed in how they do management, which came out of the pandemic, which I think is part of the reason why they're on the rise now. So I like to look at this as the inception, or even up here as the beginning of this fund, to track progress, because prior to that, I think it's a little bit different. But that's just how I see things. So let me know what you guys think. Is this one too high risk for that 10% return every single year, not including price appreciation? And drop a comment on what stock or REIT or dividend or ETF, whatever you want me to talk about in my next video. I love hearing ideas from you guys. So don't forget to always like and subscribe, and I'll see you in the next video.